Okay, will be a short video over how to account for bonds when a discount or a premium is involved. So let me get me out of the way. So let's suppose we have a needy corporation. Needy corporation is in need of financing. One way they could get financing is by issuing a note to the bank, borrowing money from the bank. But let's say the bank um, needy corporation needs more than the bank is willing to lend. So they might decide to issue bonds. And when they issue bonds, they would go through an investment banker to access the folks out here that have money. The rich tycoons, but also the pension plans and the insurance companies and other companies and individuals that are simply looking for a place to invest. And so the investment banker brings them together. The thing about a bond, when you issue a note to a bank, it's a single IOU. When you issue bonds, think of it as a stack of IOUs. And so the face value of each IOU, each bond, is typically $1,000. So let me look at an example here. Suppose Needy Corporation is wanting to issue $600,000 in bonds. Well, that would be a stack of 600 $1,000 bonds. And so one investor might buy five of them, somebody else 10, somebody else 20. Nobody takes that any bigger risk than they want to take, but Needy Corporation is able to accumulate the funds that they're after. So when Needy Corporation goes to the marketplace to borrow this money to issue these bonds, investors looking for a place to invest are going to evaluate the interest rate that this bond is paying. And we're going to look at this under three different scenarios. Um, First, we'll look at it if the market rate of interest, the rate that the market is looking for, is equal to the rate that is stated in the contract. So remember, the bond is a contract, and that contract says that Needy Corporation will pay 5% of the face value every December. Here's a picture of what that contract is agreeing to. Every December, Needy Corporation will pay $30,000 in interest, and then at the end of the 3-year term, this is a term bond, meaning the entire face value comes due at the end of the term. So the annual payments of $30,000 is only interest. It has nothing to do with paying back the $600,000. And remember, as we go through this, that this contract is written in concrete. So we can't change these future cash flows. However, we can change how much they give us today. Notice that the contract doesn't say anything about how much they will give us today. All right? So, three different scenarios. First, if the market rate is equal to the stated rate of 5%, the bonds will issue at par, meaning 100% of face value. Bond prices are given as a percentage of face value. So these would sell at 100. So let me switch down here. We would get $600,000 and we would issue the bonds payable of $600,000. That's the credit to the bond payable account. The bond payable account always is credited for the amount that's payable when these things mature. Scenario number two is the market rate is above the stated rate. So let's say the market rate is up at 7 or 8%. Well, in that case, if the market is after a 7 or 8% return, 5% doesn't look so good. So they don't want to only get 5%. So here we are trying to issue bonds with a stated rate of 5%. It's kind of like a used car with a dent in it. Well, how do you get someone to invest in a used car that has a dent? Well, you lower the price. And that's what happens with the bonds. In this case, let's say we issue the bonds at 98.5% of face value. Okay, and that works out to be 591,000. So we're receiving that cash, debit cash. Always credit the bond payable for the face value of what's payable when it matures. And in this case, since it was offered at a discount, we're going to debit an account called Discount on Bonds Payable. And this is a contra liability account. Here's the ledger down here. So, in the first example, we just had a bond payable, a liability. In the second example, we have the bond payable, but offset by this discount on bonds payable. It's a contra liability account, okay, a debit of $9,000. Now, what's gonna happen is we're gonna gradually make this discount disappear over the life of the bond. That's called amortization. And as we amortize the discount, it'll impact how much interest is recorded each period. Let's look at the third example. If the market rate is below 5%, so when the rates come down, suddenly that 5% looks pretty good, and the price of the 5% bond goes up. Let's assume it goes to 103. That's 103% of face value. That's 618,000. That's what Needy Corporation receives, the debit to cash. Credit the bond payable for the face value that's payable when it matures. And in this case, we receive more than face value. That's called a premium. So a premium on bond payable is a credit. Discounts and premiums go in the liability section of the balance sheet. Discounts are debits. They offset the bond payable. That's why it's called a contra liability. The premium is a credit. It adds to the bonds payable. So it's a valuation account. It adjusts the value of the carrying value of the bond. But in this case, it adds to it. In either case, we're going to be amortizing the discount or the premium over that 3-year period. Okay? So let me show you big picture what's happening. Here's the contract, what we're going to pay back. If we issue the bonds at a discount of $9,000, we're getting $591 at the beginning. We still have to pay all this back. So what that discount ends up increasing the amount of interest that we have to pay. It seems kind of weird. They're giving us $591 at the beginning, yet we still have to give them $600,000 at the end. Well, you always have to pay back more than you borrow. We just call that interest. So in this case, the interest is being paid in two different ways: $30,000 a year plus the maturity value that includes that discount. In the third example, when we issue the bonds at a premium, we're getting $618 at the beginning. Let me bold that and make it a little bit larger so you can see it better. So we're getting that $618 at the beginning, and yet we're only paying back $600,000. That's because the market rate of interest was less than 5%. That $18,000 premium that we don't have to pay back is simply offsetting the true cost of interest. We're paying $30,000 a year in interest. So that premium is just offsetting the true cost of interest. So here's how this works over the 3 years. Let's look at the interest payment each time. In the first example, we're just simply paying $30,000 cash. That's a debit interest expense. In the second example, so the interest expense is $30,000. Let me put that up there. In the second example, according to the contract, we're still paying $30,000, but we're also going to amortize that $9,000 discount over the 3 years. So it'd be $3,000 a year. credit the discount, and together those two credits are offset by a debit to interest expense of $33,000. So when I post this entry, the entry to the ledger, interest expense is 33, $3,000 of the discount is amortized, bringing that down to 6,000. Okay, and of course the credit goes to cash. So we do that every year for 3 years, and by the time we're done, this discount will completely disappear, and it'll be time to pay back the bond payable. In the third example, when we issued it at a premium, every year we're still going to pay $30,000 because that's what's in the contract. That's what the contract says we have to pay every December, and that, remember, is in concrete. In addition, we're going to amortize this premium of $18,000 over 3 years. That's $6,000 a year. Debit the premium. A premium has a credit balance that'll make it disappear. That'd be a debit. And so what that does is it offsets the amount of debit we would put into interest expense. So when I post this entry to the ledger, interest expense is $24,000. The premium, when I amortize the $6,000, the premium now drops down to 12, and of course the cash is credited for 30. So that's what happens every year when we make these interest payments. Let's think about the entire 3-year period. So over the course of the 3 years, what are the total amount of interest payments? Well, in each case, we're paying $30,000 a year for 3 years. That's $90,000. That's the same regardless of whether it issued at par, at a discount, or a premium, because that's what's in the contract. However, the true cost of interest, the total amount of interest expense that we recognize over the life of the bond, will be different. If it issues at par, it's simply the $30,000 a year, which is $90,000. If we issued it at a discount, the interest expense, remember, each year was $33,000. For 3 years, that's $99,000. And that ends up being equal to the $90,000 of interest payments, $30,000 a year, plus the discount. So that discount simply represents additional interest over the life of that bond. And then in the third example, we were recording interest expense of $24,000 a year. Well, times 3, that's $72,000. And that's because the total interest payments were $90,000, but the premium of $18,000 is offsetting the true cost of interest, bringing that interest over the life of the bond down to $72,000. So think big picture just for a minute. The price of a bond is influenced by market rates of interest. When the market rate is equal to the stated rate, the bonds will sell at face value. When the market rate goes up, the bond price comes down. And when the market rate comes down, the bond price goes up. Market rates of interest and bond prices are inversely related to each other. Okay, I hope that helps accounting for bonds. And less than 15 minutes. I guess that's not bad.